bond yields at that level, what are traders telling us?
Okay. Hi, good morning, Haslinda. Good morning, Rishaad. So they're telling us a lot of things. They've been trying to tell us for a while, and we haven't actually been listening to them, unfortunately, or the market hasn't been listening to them. I'm actually reminded of Henry VII's tax collector, Cardinal Morton, who used to go around. If he visited an estate and got wined and dined and feted, then he'd leave them with a huge tax bill saying they could afford to pay it because look how lavish their lifestyle was. When he went back the following year to assess them, they'd feed him on gruel, give him a really hard time, and then he'd leave them with an even bigger tax bill saying you can obviously afford it because you're living such an austere lifestyle that you have a huge amount of money to be able to pay your taxes. Well, the bond market is doing, or the long end of the bond market is actually doing something similar now, in that if we're getting these transitory inflation fears likely to lead into some kind of reaction by what I'd call the lunatic fringe members of the Fed in particular. If we get that, what that actually leads to is an increase in short-term rates that is going to cause a decrease in long-term rates because of the slowdown effect. So we're going to end up with effectively a bull flattening leading to a bear flattening. If we don't get that, well, we're just going to get the whole curve falling lower anyway. So for the last 2 or 3 months, we've been saying the one place that you need to be, the one, so almost guaranteed winner, if there is such a thing, was the long end of the bond market. And that's really what's happening now. It's, heads you win, tails you don't lose.
Paul, stubbornly low yield. That leads us to our question of the day. When will 10-year yield get to 1%? So we have another problem on top of this, which is the long-term outlook is looking really grim. If you look at the forwards, the 5-5 forwards, they're all looking really, really grim. So at some point, we have to get there. The question is, do we get the lunatic fringe from the Fed intervening first and tapering and tightening, which might lead to a bit of a delay in getting there, but we'll get there and some, or do we just get there in a nice straight line? Either way, it's inevitable. You'd have to, it's above my pay grade Paul,
to try and
Paul, the question is
when.
When, Paul?
That's the answer I don't have. I think if you're holding 10 years now, you're going to be happy with it. It's looking like, the market's saying sometime beyond 5 years, but I think we could get there a lot sooner.
Paul Carter-Woolsey, of course, was also tried for treason. He died of natural causes in the end, but he died for treason. But I'm very interested in knowing who's being really treasonous, if there's such a word, in the Fed, because at the moment you're saying there's a lunatic fringe. Who are they?
So there's this hawkish kind of contingent in the Fed. I mean, luckily Rosengren isn't a voting member anymore, but we've still got the likes of Randy Qualls. We've got these hawks. My good friend Steve Keen, the Australian economist, he has a description of these neoconservative economists who have this kind of totally outdated view. He sees them a bit as Ptolemaic astrologers in the age of Copernicus. No idea what's going on and can't understand why it's right. So I think that's what we've got with this sort of older brigade of the Fed. If we get to an era where it's Lyle Brainard in charge, that actually is possibly a big step forward. Jerome Powell, I think, is sort of as far away from the lunatic fringe as he can position himself. But when we get the minutes out, we may get Brainard and Powell having to spend the next week going around apologizing and tidying up for any mess that's created in what the hawks have left in the minutes.
Paul, what about, that's one of your 4 market risks, the lunatic fringe there in the Fed, as you put it. But on top of that, you've got deflation, recession, depression. Well, you covered all the bases, haven't you?
Well, and they're all interlinked. I mean, these are all, consequences of growth slowdown in an indebted world, and it's basically just different stages that we'll get through. A depression essentially is a recession, a severe recession that happens when there's way too much debt in the system, and it causes debt deflation as well. So we still see the outlook for growth
looking out longer term as being really poor. And we don't, we think the market's been fooled. The equity markets have been fooled by, some of the short-term transitory stuff. The growth that we're seeing, second-hand cars went up like crazy because suddenly there was a supply shock. Lumber prices went up like crazy because there was a supply shock. Oil prices went up for supply shock. So we've seen a supply shock, and people are misinterpreting that as growth and inflation. I don't think it's either. I think the opposite problem still applies.
Let's talk about oil. I mean, Citi's saying $80 a barrel will come sooner than you think, and $80 a barrel means, the economic recovery will be at risk.
Yeah, I think $40 a barrel will come sooner than they think. I think that's a much, much bigger risk. I don't know how high it can go before it retraces, but the retrace is baked in. All the data that we're seeing, the long-term structural problems, then weaker oil prices are baked in. I don't know how high they go before we get to there, but 40 definitely at some point, 80 maybe we'll visit that on the way.